Hello, everyone. I'm here with my two favorite guys who I work with closely every day. Most of you probably know Al and Marcin from AMP Consulting Group. Appreciate you joining us and hope everybody had a great Thanksgiving. We just wanted to address some of the questions that we receive from people on the day-to-day, especially now that the election results are behind us, and wanted to pick the guys' brains and certainly have anyone pick my brain. And we're going to start with speaking about our overall thoughts and takeaways from the election. So Al or Marcin, whoever wants to start, share with me some of your thoughts from the election, maybe a 1 to 2 minute synopsis of what your sentiments are, what you see, what comes of all this now that they're behind
Thank you,
us.
Rulla, and thank you for everybody joining us. Before I dive in actually what happened to the election, I'm going to back up a little bit because this was a very unusual year, especially when it comes to the financial markets. Normally, at the start of an election year, we see a lot of volatility and the markets really do nothing up until we know the two candidates. This time it was a little bit different in that the markets continued to go up from the beginning of the year because we kind of knew that President Trump is going to be in place. What we also, my initial perspective is that the pundits got it once again totally wrong. We thought this would be a very tightly contested election, but President Trump won overwhelmingly, and not only did he win the electoral vote, but he also won the popular vote, which people were saying was a very, very slim chance of that happening. So the election was unanimous, and the Republicans won also the Senate and the House. So it was an overwhelming, stamp of approval for President Trump. My general feeling is probably we're going to discuss in this webinar is probably the similar trends of what we saw under President Trump's first presidency in 2016 are most likely going to play out, and we'll delve into this afternoon.
Fantastic.
Yeah, thanks, Rulla, and hi, everybody, and appreciate you guys tuning in. A lot of what Marcin said, I think the most surprising thing was how one-sided the victory was. I think nobody expected that coming in. And I think that helped calm markets. You saw the very next day, the response of it, the market had such a strong reaction. Part of that was because there wasn't this overhang of uncertainty of people saying, well, the election results actually formalized at this point. So I think that was very welcomed by markets. And now that you have kind of Republicans in all three chambers, the presidency and Congress, the Senate, Congress, and presidency, I think, animal spirits are alive. Even on days that you would think that the market would pull back a little bit, given all the geopolitical tension, the market has been incredibly resilient, constantly making these new highs. So I think markets welcome it. I think some of the appointments, specifically Scott Bessent, has been kind of received very favorably by markets. He's a prominent hedge fund investor, and I think so far so good on the economic front. So we'll see how things play out, but I think markets responded very, very favorably to this here.
I agree. Appreciate it. I think to dovetail on both of your points, thank you guys. You both make great points as always. I think that now that we do have more certainty, now that the dust has settled and we know who's going to be taking power, and because President Trump and his future administration or chosen administration have a plan, people in the markets do feel like they know what to expect, even though, as you mentioned, we do have a number of issues to still address domestically as well as globally. We now know some of what he's going to do. And what I like about President Trump is that there's a lot of noise, right? There's a lot of noise about tariffs and other things and, mass deportation and things of that nature, which will probably take place and be enforced by him and his administration. But his core goal as a business person and a former president, his core goal is growth for this country. And who doesn't want growth, both from a business perspective, from a corporate perspective, as well as individual and household perspectives? I feel as though that's going to help the nation tremendously. I feel as though that's going to strengthen our economy. And I think chiefly, we want to have our US dollar regain its power and maintain its #1 position as far as currencies around the country. So that part I'm excited about. I'm sure you're both excited about it as well. Hopefully most people are excited about that, but we'll see what the future holds once January rolls around. All right, perfect. So either one of you can choose to answer this. Another question that I often get from clients is, under a Trump presidency, what sectors do you anticipate being the biggest beneficiaries when it comes to the market?
Yeah, so I'll start there, and then Marcin, I'll hand it over to you for your thoughts. So we had the pleasure of interviewing Mira Pandit last month. She's the chief global strategist for JP Morgan. She writes the Guide to Markets. A lot of people are familiar with that, and she went through a couple of different things that we found interesting. And post-election, our team put together a pretty good playbook here. I'll share it so you can all see it. I think, Rulla, you'll probably be disseminating this at some point, but it discusses some of the top institutional asset managers' thoughts on the election and what would play out. And one interesting one that we really liked was Goldman Sachs' perspective in terms of who the winners, who the losers are. And this seemed to be relatively consensus in terms of small caps, cyclicals industries, things like industrials, financials, consumer discretionary, anything that you can think of that has more of a domestic agenda bias to it. Those in an America first kind of narrative of President Trump or President-elect Trump seem to be clear winners. And you've already seen the market start responding to that. So you saw the Russell 2000, which is the small cap index, have a really great rally since President Trump or President-elect Trump got elected. You saw financials rally, industrials rally. So you've seen a lot of these things happening already. In the conversation with Mira, she did point out, which I thought was interesting, that sometimes things are less intuitive than you might think. She pointed out an interesting fact that under the Trump's first administration, renewable energy, believe it or not, had a better performance than it did under Biden's presidency, which would be counterintuitive. Conversely, under Biden, traditional fossil fuels actually had a better performance under Biden's presidency than under Trump. So things always don't work out the way they seem, but clearly the winners are going to be things that are domestically focused as we move from more of kind of a global economy to one that's more focused inward, more focused on a domestic agenda. Marcin, I'll pass it to you. Any thoughts there?
These are very interesting points. I would also just like to remind our audience to stay invested, irrespective of what your political inclinations are. As Al mentioned, it's very difficult to pick sectors, and sometimes the things that we expect might not necessarily happen. But the importance of having an equity exposure in your portfolio and having a great financial planner like Rulla to guide you in that, kind of sticking to the plan and making sure that you are not deviating based on your political point of view, because we have seen that. We've had clients literally 48 hours before election that were saying we want to take all of our money out of the markets depending on who's going to win. And what happens is those people never go back into the financial markets. Generally, the things looking forward do look really, really good. I think Rulla also mentioned at the beginning that Trump is going to have a really strong dollar policy. There's a lot of research that shows that a strong currency is very highly correlated with an equity market. There's also these other tailwinds that demographics, artificial intelligence, that probably are going to have a positive inclination for the financial markets going forward in general. And as Al mentioned, the specific sectors, financials, industrials, going to be also probably well impacted.
Thank you. It makes a lot of sense. Lots going on. It's exciting. How could changes in tax policy influence the approach to portfolio allocation for our clients and asset allocation strategies? Because, taxes are always a major factor.
Yeah, that's a great question, Rulla. So I think the first most intuitive answer is that markets likely stay buoyant because they're not fearing a change in corporate tax policy. So one of the things that Marcin and I really were discussing pre-election was the fact that if you had kind of a Democratic presidency that had any support from Congress, you likely had an increase in the corporate tax rate, and we didn't think that that was priced in. So we thought if that ended up coming to fruition, you probably would see the market back off a little bit just because of changing corporate tax rate. You do the math, they earn less money, earnings go down, multiples go down, everything kind of consolidates a little bit. So the first, I guess, beneficiary of this new presidency has clearly been the markets and corporate tax rates, at least staying where they are, if not actually coming down. I think the proposal's down to 15%. You likely get an extension of all the tax cuts, which are great. More people keeping more of their dollars leads to a kind of more consumption, history shows. So that's a good thing for sure. I do think that you lose a little bit of demand for munis that you may have seen come if you did get a tax regime that was going to be a little bit more punitive. So if you saw taxes being a bigger concern, more people would shift demand to munis. Munis have been something that we've thought are underpriced relative to other fixed income instruments. And a lot of that is because institutions don't buy muni bonds. People buy muni bonds, retail investors. And since you had the big sell-off in rates in 2022, the market, people haven't really rushed back to the market to buy muni bonds. So I think at the margin, maybe you get a little less demand there on muni bonds because people are anticipating a lower tax regime. But overall, again, you probably have an extension of all these tax cuts. You get a more favorable corporate tax rate. Markets love that.
And a quick question on that. So do we think that this extension in the corporate tax cuts and maybe having a little bit more motivation, being able to paint a better picture as far as business plans are concerned for companies, might prompt and stimulate growth as far as employment, more hiring? Do we think that might come into play at all?
Yeah,
If you have any opinion on that.
Yeah, I think profit margins kind of stay elevated. They've been historically elevated for some time now. I think any gains you might get from more hiring, some of that gets lost to technology and AI and productivity gains on that front. So that may prove to be a bit of a wash there. But certainly less taxes are things that the market likes. The market rather have less taxes than higher taxes, full stop. That's pretty clear. So as it impacts hiring, I think that's a more difficult question just because the hiring will be more companies looking to reduce costs, increase productivity, and unfortunately, there's going to be some labor displacement there just because, you know, these new technologies coming to market.
Yeah, those are a big factor. They've definitely changed the way we operate and we work on a day-to-day. Inflation's obviously been a big topic for all of us, especially over the past couple of years. And we see how that's really impacted the average household and everyone across the board, whether one, household might be lower income, higher income. And that's also something that we've had to plan around, and you've had to plan around when designing your portfolios for AMP, and that I've had to account for, especially with my clients entering retirement. Marcin, if you'd like to answer this, what are your thoughts on what a Trump presidency could mean for inflation in the coming years?
I like to give what the market says, because I think the markets are, for the most part, very, very efficient. And the market's view of inflation on a 10-year basis is going to be around 2.5% to 3%. We have TIPS, which are Treasury inflated bonds, trading at around 2%, and the 10-year bond is around 4.5%. So if you take the difference between the two, the 4.5 and the TIPS call it 2, the market thinks that in the long term, inflation is going to be around 2.5%. Now, as we know, the Federal Reserve and Chairman Powell like to see that closer to the 2% threshold. The market just doesn't believe that we're going to get there in the long term. So inflation is probably going to be a little bit elevated from where the Fed likes it to be. And of course, markets are moving and things might change. Deficit spending is going to get more and more in focus. We definitely spend more than we take in. And now with the reduction in taxes, that deficit might potentially grow. But on average, our deficit grows by about $2 trillion a year. Given the tax implications, hopefully we can grow our way out of it. But on average, our deficit has been increasing by about 2 trillion a year. So that might be adding to the inflation. Now, things that might reduce the amount of inflation are the new agency which President Trump proposed, the Dodge, that hopefully is going to cut out some fat and reduce the amount of spending. We've already talked about the strong dollar policy. So those are the counter-reacting forces. But I think in the long term, inflation is going to be somewhere between that 2 to 4%, and probably the median is around 3%.
Okay. Well, that's in line with what we've seen historically. Normally, when I run projections, I utilize a 2.5 to 3%, inflation factor, just to be on the safe side. That would certainly be an improvement from what we've seen in the past few years, right? So
as long as inflation remains stable, because the main things that markets don't like is big jumps in prices, and that's what we saw after COVID, where inflation was like it went from 2 to 10 and then now back to 2. And as you rightly point out, a lot of people on the streets are struggling. I read an article that 90% of actually Americans, excuse me, do not have enough money to actually save for investments because of this massive, about 25% increase in prices over the past 2 or 3 years. So that is definitely a problem. And hopefully we can lower the volatility of inflation and keep it around that band. Because if inflation does remain stable, that is not only good for consumers, that is also good for firms, because they can make more reasonable projections if the rate of inflation is steady.
absolutely.
Yeah, and
Do you want to
just to
add
add to that, yeah, I actually think that inflation's probably underpriced right now, or at least I think that's at least the risk to be considered. Just because if you do get a strong economy, you get strong growth, that by definition can lead to some inflation over time. And I think that's probably one of the biggest things I'll be looking for over the next couple of years is market expectations of inflation versus realized inflation. What's the mismatch there? And I think we'll talk about that in a little bit. But you can see a world, given all our deficits, given kind of a return to animal spirits, given kind of an unleashing of the economy, if that's the promise, where inflation might be ticking up again. And that would be something that we'd certainly be paying attention to.
Appreciate it. All makes sense. So do we address market volatility now that we're post-election? Obviously, we have seen a spike in the market reacting favorably to the outcome. Do we predict that there will be any market volatility from what we know in the coming months as we transition into the new year, or at least Q1 2025?
So let me start off by saying, as you mentioned, Rulla, we've had really very strong back-to-back years. So not only 2024 has been strong, where the market is up, well over 20%. 2023 has also been strong. Going back in history, we've had eight times in the past, since the 1920s, where the market has been up more than 20% on a back-to-back basis. And out of those 8 times, only 2 years the following year have been negative. That was in 1977 and 2000. So if you were a betting man, just from a statistical point of view, most likely 2025 is still going to be a positive year. In addition to all the positive stuff that we mentioned on this podcast, more specifically the AI, the demographics, these are all going to be tailwinds for the markets. The lower level of interest rates, which are potentially coming. It's hard to see a recession in the next 6 to 12 months, and we're still optimistic, and that's the way we have positioned our portfolios. A little bit overweight equities, because we don't see really a recession risk in 2025, and most likely an uptick in the market.
Yeah, that being said, to add to that, Marcin, normal bouts of volatility are completely normal. So even if you're in an uptrend, it's important to remind anybody watching and tuning here today is that volatility comes for the most random reasons. The wrong rocket gets launched in the Middle East, and suddenly the market gets a little bit jittery, or you have an overreaction to policy in France, and they have election outcomes, and they have a big thing going on right now. So for any given reason, you can expect a 10% drop in markets about every 2 years or so. That's kind of the market average of how often it happens. It should be important to note that those tend to be completely normal within market growth cycles. Nothing goes up in a straight line. And in fact, you actually like times where the market digests a little bit because it keeps things from kind of getting too bubbly. You get some gains, you digest a bit, you kind of keep going further and marching higher. So just for anyone tuning in on this call, certainly we think that there's a favorable backdrop to the market, but volatility can strike for any reason. You shouldn't let that unnerve you. Marcin and I completely agree that the big risks, the recessionary risks that everyone fears, those, it's hard to see where those would materialize as of right now. The economy's strong, and you are going to have some pro-growth policy right now. So a lot of tailwinds behind that.
Oh, that's what everyone likes to
Yeah.
hear.
There's also a huge amount of inflows into U.S. equities. U.S. equities over the past 5 years have had 5 times the amount of inflows compared to Europe, Japan, and emerging markets. So international players love U.S. equities. It's hard to, that's where all the growth engine of the world is coming from. So not only the positive fundamentals are there, but there's also positive inflows. And we haven't even mentioned animal spirits. Now that people know that President Trump will be in power, just on the back of that, people might just, pile more money into the markets. So it's hard to see a red market in 2025, but as Al mentioned, anything can happen. And even in strongest bull markets, there have been studies that show that an average drawdown of 12% does happen. So it's nothing to be out of the ordinary. The main thing is not to panic in those times. And here I go once again to our beautiful presenter, Rulla, who will keep you in good hands and make sure that you don't panic at the wrong time and sell when there is, today we're seeing headlines about South Korea and stuff like that. So
we will talk about that actually toward the end. I love touching upon that just so that everybody can remain focused on their intermediate to longer term goal and just not let any little headline disrupt their plan. Volatility brings opportunity for those of you who might not understand that, or be in the seats that we're sitting in right now. Volatility, as Al mentioned, during any market is still a positive thing because it does bring a lot of opportunity. And Marcin, as you mentioned, I should have jotted this down because I wanted to make a point based upon the point that you just made. I'll circle back to it. Well, in any case, I'm going to go on and then I'll circle back as soon as it comes back to me. As far as sectors, guys, are there any sectors that we would consider right now or that you would consider as safe havens for clients, especially those who might have whatever concerns, need liquidity, just be naturally a little bit more risk averse and or on the cusp of retirement where they want a safer space?
Yeah, so I'll start there and then I'll pass it to you, Marcin. So I think one area are tips, which I think Marcin alluded to. These are treasury inflation protected securities. What they do is they tend to give you a smaller coupon, but then they make up the difference on realized inflation and CPI. And if you think that inflation is slightly underpriced, that might be a convenient way to get a little bit of a pop if inflation ends up coming a little hotter than people expect. And if you think that the market's going to have some good growth years, I think it's at least in the realm of possibilities, a strong possibility that you have inflation be a little bit more than people are pricing, just because strong market growth can lead to inflation over the medium term. So I think tips are an interesting place. People hold a lot of nominal bonds. They're just your normal government bonds that people know that are coupon bearing. And there might be an impulse of those to do good as rates come down. But I also think there's a world that rates don't come down now as far as people initially anticipated, just because of the fact that if you're anticipating more growth, there's not a huge need to drop rates considerably because you don't want to stoke inflation back.
And another asset that we liked, and we have actually liked it for well over a year, is gold. We actually shifted 5% of our portfolio into GLD, which basically tracks gold. And this asset is probably going to continue to rise in the future. It is a very good performing asset if you look at the long term. And now we actually see more headlines. There's a lot of BRIC countries. These are Russia and predominantly China, South Africa. This was in the news over the weekend where they want to diversify away from the dollar. A lot of central banks are purchasing gold and building up their gold reserves. So we see this asset class, it has performed very well and at a small level of volatility than the S&P 500. That's also a safe haven asset that people can potentially buy. It's also a great hedge against inflation. So it ticks multiple boxes.
Thank you. Well, you both do a beautiful job at really staying 2 steps ahead as far as managing the portfolios and research and development. And that's what, we bear a lot of weight on, and just trying to create the nucleus and then the orbit, around each portfolio so it's properly balanced and meets each objective. So I thank you both for that. Helps contribute to everyone's success. All right, let's talk behavioral finance, which Marcin has touched upon a couple of times throughout this webinar today. And people most often ask me about this, and a lot of what I do, that's sometimes people don't see and clients don't quite see, and I consider to sometimes be a thankless job, is helping those remain calm, helping clients maintain their focus, like I mentioned earlier, especially on their intermediate and longer term goals, not losing sight of everything that's important that we've planned for while all these things happen intra-year, and as we go along, because we will have volatility, we will have geopolitical challenges, we will have some unpredictable, but in general, there is a method to the algorithm, and we work very hard day in and day out behind the scenes to make sure that we don't not only understand clients' goals and objectives and background, but also understand the markets through the research and development, through what both of you do and our extended team does, both domestically and internationally. So I've had to spend a lot of my time throughout down markets just helping clients, especially 2022, having been one of the worst markets, in history, helping clients not walk off a ledge. And I don't have many. And I try to just remain very proactive so that people know what to expect, or at least I'm guiding them along. We don't want anybody to lose hope or make rash decisions that could cause more of a deficit, for them down the line. What often happens is, and I don't know if you want to speak to the slide, it would be great. Clients sometimes, and not my own personal, but just your general investors out there, particularly the novice investors, might decide to liquidate when something triggers them. And they're often liquidating on a downswing. And that's truly when you lose most. People will see, based upon charts and studies we have, I think some of which you both are going to share, are if you do stay the course and perhaps tweak portfolios or decisions accordingly, you don't lose out on the longer term gain. And oftentimes investors try to jump in when things are already on the rise. So not only do they lose, what happens is they liquidate, jump out of the market, try to get back in when the market's already in its expansion mode again, and it's on the rise, and they end up losing. They have a beta there. They end up losing, however many percentage points, because they tried to jump in at the wrong time. So it's almost impossible to time the market perfectly. And that's what we avoid having to do and that's the purpose of sticking to a well-defined plan.
Yeah, so this kind of goes to something that Rulla just spoke about, behavioral finance. It's probably the most important role of a financial advisor. Vanguard did this study and looking at a number of factors outside of returns of what financial advisors do. And more than half of it was actually behavioral coaching. A big part is basically preventing you doing the wrong thing at the wrong time. This is a very interesting chart, which is from JP Morgan. It is for this year. So it shows the performance of the S&P 500, which we know has done phenomenally this year, up about 27%, versus the performance of an average retail investor. with the average retail investor is only about 3% up this year. So there's about a 24% gap between what the market has done and between the retail investor trying to time the market, trying to, buy the bottom and sell the top. And, beating the market is very, very difficult. And we can clearly see this in this chart that the retail investor has dramatically underperformed the S&P 500 this year. It's actually one of the worst years for the retail investor in recorded history. And if you compound those dollars, which they lost out this year over 10, 15, 20 years, of many of you on this call are building for retirement, that has a massive impact on your nest egg at the end of the time. So just goes to showing that you need somebody kind of often to hold your hand and preventing you from doing the wrong thing at the wrong time. And especially a year like we had this year, where we said we had a lot of people making irrational decisions about who's going to come into power. We had another chart that we haven't brought here, but markets actually, it doesn't really matter who's in power. Markets generally tend to go up over time. And the reason for that is inflation. Inflation is normally positive over time, and earnings and, earnings of companies tend to increase over time. So, buying the top, selling the bottom is very, very difficult. Even me and Al cannot do this 100% all the time. Even the greatest investors only get 6 out of 10 right. An average investor only gets it about 2 out of 10. So it is a very difficult art, and we try our best. And we are not always successful, but if we are successful more than the average, then we are doing well for you.
Yeah, and that's a great chart you're talking about here. And Marcin, I can share this here for a second. But really, it's about making sure you stay invested. That's such an important part of the investment game over the long term, especially when you work with a planner like Rulla, who certainly has factored in a lot of these times into her modeling and her planning. We know that because we have many, many different conversations with Rulla about this and outlooks and how we're projecting things. So it's certainly things that get factored in. But this chart, I think, says it all here. If you go back to January of 1926, and you look at the growth of $1,000 over that time frame till the end of 2023, really, it didn't matter if it was a Republican president, a Democratic president. The markets have this tailwind over the long term, and that's really what you want to play on. Certainly, when markets do have bouts of volatility, you want a management team that can take advantage of that and be opportunistic on your behalf. I think that's important. And that's something that we've executed on really, really well through time. But that's in the context of making sure that you're actually still in the game. Rulla mentioned this earlier. I think this is such an important point. If you're unnerved by something that happens in the market and then you go to cash, it's almost impossible to get back in, because you'll always be concerned that the shoe hasn't completely fallen yet. Everything's going to still get worse. And then when you get back in is when all signs are clear. But by that point, the market has already rallied significantly and you've missed out on all of those gains. So $1,000 in 1926 would have turned to over $14.5 million. Pretty good return. And it didn't matter if it was a Republican or a Democrat for the most part. So staying invested over the long term really matters. And we work closely with Rulla to ensure that when we do get volatility, that's actually your friend for the long-term investor. Volatility is a chance for you to leapfrog in wealth if you can do smart things during that time. So we're honored to work with someone like Rulla, who pays so much attention to these types of topics here. And I really think that that's an important chart to show for that reason.
No, that's great. There are a lot of great points. Everybody is triggered by different things, and that's normal. And again, we just have to remember as investors not to let the emotion get in the way. We exist as professionals, as most of you know, for a reason. Everyone has their role, and we are always here to help and consult, keep the calm, try to stay a step or two ahead. We don't set anything and forget it. Those of you who work with me know how much I care. And I work very closely with Al and Marcin because I know how vested they are and how much they care and how invested they are in the day-to-day of what they do. And they do it very well. And so, with that being said, here's hoping for a fabulous year end and a wonderful 2025 rest assured that we will be 2 feet in this industry as always and working hard for you. When you win, we win. And that's what we want as we change hands in the presidency and enter our new year. So happy holidays to everyone. If we don't see you sooner, we appreciate you joining us. I thank Alan Marcin, 2 of my favorite guys, the nerds of the operation, for always helping to guide me behind the scenes, and look forward to seeing you all soon.